听说大量的外资撤离苏州了。
I recently heard that a large number of foreign businesses are leaving Suzhou, with over 20,000 foreign companies shutting down and moving to Southeast Asia. After the foreign capital left, Suzhou experienced a wave of unemployment, with thousands of people facing job losses. Recently, rumors have been spreading on Chinese social media that Suzhou, once a manufacturing hub in China, has been severely affected. Foreign companies are said to be withdrawing on a large scale, with over 20,000 businesses either closing or suspending operations. Unemployment is reportedly rising sharply, plunging Suzhou's economy into a slump and forcing hundreds of thousands of migrant workers to leave the city. As soon as these rumors surfaced, Suzhou's government issued a statement denying the claims, saying the information was false. They stated that not only has foreign investment not decreased, but has actually increased. As of October 2024, Suzhou had 24,000 foreign-funded enterprises, 35 more than in September, and nearly 1,000 more than in December 2023. Although the number of foreign companies in Suzhou hasn't declined, the actual amount of foreign investment has dropped significantly. In the first 10 months of this year, the number of foreign and Hong Kong, Macau, and Taiwanese businesses increased by 2%, but the actual amount of foreign investment used in Suzhou was just over $5 billion, a decrease of nearly 25% compared to the same period last year. One person familiar with the situation commented that while the foreign company they work for is still operating, most of its production has moved to Vietnam. Business professor Xie Tian from the University of South Carolina explained that while more companies are being registered, the actual amount of foreign investment is decreasing. This trend suggests that many of these companies might just be shell companies or companies focusing on trade, which don't require significant financial input in China. Some companies might simply register to explore potential partnerships or to assist in moving funds out of China without making real investments.
Today
I saw Suzhou's official statement denying the rumors about foreign businesses leaving. I'm in Suzhou's industrial park, where many foreign enterprises are located. I'd like to share my personal experience from the perspective of an ordinary person living in Suzhou. When I first arrived in Suzhou in the summer of 2012, the Oriental Gate wasn't even completed yet. I remember crowded buses, heavy traffic, and bustling streets in the evening. Many of my colleagues bought cars back then, and I did too. Our business even expanded to Kushan, which felt even more crowded because of the large number of Taiwanese businesses there. Some factories had tens of thousands of workers, and even smaller ones employed thousands. Every day, countless buses transported workers back to their dorms, and the whole area was bustling with activity. This continued until the pandemic hit.
This vlogger, who has lived in Suzhou for nearly a decade, revealed that after the pandemic, fewer people came to the city. Staffing agencies began to see workers, but had no jobs to place them in. Especially in the past 2 years, many staffing agencies have gradually closed, and fewer factories are hiring. In the past, workers could leave one factory and immediately find another job the same day. Now things have changed. It's hard to find a new job after resigning, so fewer people are coming to Suzhou and more are leaving. The streets are getting emptier. How's the job market in Suzhou, China's strongest prefecture-level city this year? You might not believe it if I told you. Take a look. This is one of Suzhou's train stations. In previous years, seasonal workers would already be arriving for winter jobs, but now there are noticeably fewer people. Even fewer are coming out with luggage to look for work. A longtime worker in Suzhou said, "I've already been laid off. I got an N+1 compensation." The pharmaceutical industry in Suzhou is struggling, especially in biopharmaceuticals. A few years ago, Japanese company Nitto Denko announced the closure of its factory in Suzhou Industrial Park, Jiangsu, putting over 1,000 employees at risk of unemployment. At that time, the news about foreign businesses leaving made headlines. The Ministry of Commerce quickly responded, clarifying that only one production line was being shut down and the company would continue operating in Suzhou. Reporters later visited the site and confirmed that the company hadn't closed, but many workers were waiting for severance payments. In July 2023, ASUS's Suzhou plant reportedly laid off over 100 employees. At the beginning of 2024, Bosch, the global automotive parts giant, announced plans to lay off 1,200 employees from its overseas software department over the next 3 years, drawing widespread attention. By August 2024, there were rumors that Canon's wholly owned Japanese factory in Suzhou was laying off 1,000 workers. The compensation plan was either N plus 12 or 2N plus 12. A worker in Suzhou commented, "When it comes to layoffs and compensation, foreign companies are indeed more generous. Back then, I voluntarily accepted being laid off to receive higher compensation. Later, I joined a domestic company and felt like the sky was falling. I couldn't understand why one person had to do the work of 8. However, foreign companies leaving Suzhou haven't always been a smooth exit. A Japanese business owner shared a harrowing experience on Japanese social media about his escape from Suzhou, which quickly went viral. According to him, "Our Suzhou factory faced financial difficulties because Chinese state-owned enterprises owed us huge amounts of unpaid invoices. With China's economic environment worsening, we decided to leave Suzhou at the beginning of this year. But when I tried to leave, I was suddenly detained at the People's Court in Suzhou's Xiangcheng district and prohibited from leaving the country. Upon closer inspection, I found that all the documents against me were forged. Despite requesting handwriting analysis, they refused to conduct it. Their goal was still money." In the end, after repeatedly submitting documents to various courts, and with the help of the Japanese Consulate General in Shanghai, the business owner endured a long 107-day wait. After several last-minute negotiations, he was finally allowed to leave China and return to his family on the condition of withdrawing his appeal. It's not just Suzhou facing the withdrawal of foreign businesses. As China's economy continues to slow and sanctions from the US and Europe intensify, foreign companies in other Chinese cities are also leaving, shifting their investments to Southeast Asia, India, and other regions. A study by Bain & Company, a US-based global strategy consulting firm, found that even before Donald Trump won the US presidential election, the trend of top global companies moving production and operations out of China was accelerating. Their survey involved 166 CEOs and COOs. Of the executives interviewed, 69% reported their companies were moving production out of China, a 14% increase from 55% in 2022. Where are these companies going? The survey revealed the top 5 destinations: the Indian subcontinent, the US and Canada, Southeast Asia, Western Europe, and Latin America. 39% moved to the Indian subcontinent, 16% relocated to the US and Canada, 11% shifted to Southeast Asia, 10% went to Western Europe, and 8% chose Latin America. The report also noted that more companies are reshoring operations back to their home countries or nearshoring to neighboring countries. This survey was completed in July 2024 and published in Fortune magazine. The findings showed that 81% of executives plan to shift their supply chains closer to their markets, a significant jump from 63% in 2022. Bain & Company attributed the trend of companies moving out of China to rising geopolitical uncertainties and increasing costs. The report also highlighted that for 39% of the U.S. companies surveyed, the Inflation Reduction Act, passed by the U.S. Congress in 2022, was another factor driving business back to the U.S. The report warned that the likelihood of the U.S. significantly raising tariffs on Chinese imports could deal another severe blow to China, the world's second-largest economy. China's economy has fallen into a deflationary trap, driven by the collapse of the real estate market and a mounting debt crisis. Over the past 2 years, China's inflation data has consistently shown contraction. This has led to widespread factory closures, reduced corporate investment, surging unemployment, and a sharp decline in consumer spending. One of the most pressing issues is China's growing overcapacity, which is facing increasing resistance from other countries. Foreign companies were once the most sought-after employers for Chinese workers. In the past, Japanese companies provided significant job opportunities in China. However, they are now continuously withdrawing or scaling back their investments. The WeChat public account, Qing Shuo's Circle of Friends, cited publicly available corporate registration data from March 2023, showing that Panasonic Holdings alone employed more than 74,000 people in China. Major Japanese automakers like Nissan, Toyota, and Honda each employed around 40,000 workers in the country. The top 20 Japanese companies in China collectively employed nearly 460,000 workers. Additionally, major Japanese retail and restaurant chains also provided numerous job opportunities. But things are changing. More Japanese companies are withdrawing or cutting investments. According to Nikkei China, from April to June this year, Japanese companies' equipment investment in mainland China and Hong Kong dropped by 16% year-on-year. Their share of overseas investment in China fell to 13.6%, marking 2 consecutive quarters below Europe. In June, Nissan shut down its factory in Changzhou, which had an annual production capacity of 130,000 vehicles, accounting for 10% of its total output in China. In July, Honda closed a factory in Guangdong and announced plans to suspend production at its Hubei plant. In October 2023, Mitsubishi Motors formally decided to exit vehicle manufacturing in China. Over the past 2 years, a wave of Japanese companies has left China, including Nippon Steel, Bridgestone, Canon, Ricoh, Sony, and Kato Works. Beyond Japanese companies, Taiwanese businesses are also starting to pull out of China. In September, the U.S. think tank Center for Strategic and International Studies, CSIS, published a report titled Diversification, Not Decoupling. Taiwan's industry responds to geopolitical risks. The report revealed that 87.4% of Taiwanese businesses are either planning or considering leaving mainland China. The top 3 reasons cited by Taiwanese businesses for leaving China were high labor costs, 33%, potential supply chain disruptions, 25.9%, changes in investment policies, 25.2%. As multinational companies continue to withdraw from China, the number of jobs provided by foreign enterprises is rapidly declining. According to the China Statistical Yearbook 2024, published by the CCP's National Bureau of Statistics, employment in foreign enterprises dropped by 15% in 2023 to 9.88 million people. This marked the steepest decline since the data was first published in 1990, and the first time since 2009 that the number fell below 10 million. In August 2021, during a press conference by China State Council Information Office, Chinese Commerce Minister Wang Wentao stated that although foreign enterprises made up just 2% of the market entities, they drove employment for approximately 40 million people, accounting for 1/10 of China's urban workforce. These enterprises contributed to 1/6 of the country's tax revenue and 2/5 of its imports and exports. However, according to the Chinese Ministry of Commerce, in the first 3 quarters of this year, actual foreign direct investment, FDI, in China amounted to 640.6 billion yuan, reflecting a 30.4% year-on-year decrease. Data from China State Administration of Foreign Exchange showed that in the 3rd quarter, the liabilities under direct investment in the balance of payments fell by $8.1 billion, marking the 2nd consecutive quarter of negative growth. Bloomberg pointed out that if this downward trend continues for the remainder of the year, it will mark the first annual net outflow of FDI since comparable data became available in 1990. There are 2 primary reasons for foreign capital withdrawing from China. An article titled The Great Escape of Foreign Enterprises, published by Guangyan Finance, stated that China is no longer the promised land for international investment, but has become a harsh environment. Those who leave early can avoid greater losses. The article highlighted that the decision by foreign enterprises to partially or completely exit the Chinese market is no longer isolated, but part of a growing trend. The reasons for this withdrawal are multifaceted, involving political, economic, and social factors. Economic slowdown is one of the major factors driving foreign companies away. In 2010, China's GDP growth rate was 10.6%, but by 2023, it had dropped to around 5.2%. At the same time, the overall cost of doing business in China has risen significantly, including increases in labor, land, and environmental protection costs. According to the latest data, the average wage in China's manufacturing sector reached 97,379 yuan in 2021, more than double the figure from 2010. Another key factor is rising geopolitical tensions. The U.S.-China trade war and unstable China-EU relations have made the operating environment for foreign enterprises in China increasingly complex and uncertain. Additionally, countries like the U.S. have imposed stricter national security reviews on American companies investing in China, limiting the flow of American capital into the country. According to data cited by Guangyan Finance from China State Administration for Industry and Commerce and the Ministry of Commerce, approximately 1,000 foreign enterprises fully exited the Chinese market between 2015 and 2020. Regarding the withdrawal of foreign enterprises, Taipei-based venture capital expert Wang Chiyuan told Voice of America that this appears to be an inevitable trend. Beyond the ongoing tensions between the U.S. and China, the potential for increased sanctions and pressure on China when Donald Trump returns to office is a significant factor. In recent years, global supply chains have gradually shifted under the influence of geopolitical factors and tariff wars, leading to the adoption of a China Plus One strategy. This strategy encourages multinational corporations to establish production lines in Southeast Asia alongside their Chinese operations. As production gradually relocates to other countries, investments in China are naturally decreasing. Huang Chiyuan also mentioned that China's sluggish consumer market is forcing unprofitable foreign businesses to withdraw. For example, in late November, reports emerged that coffee giant Starbucks was considering selling part of its stake in the Chinese market to Chinese companies or equity funds. Regarding investment, that not only are foreign investors pessimistic about prospects in China, but Chinese companies are also scaling back domestic investments and increasingly looking overseas. In addition to foreign business withdrawals, capital flows into China's financial markets have also experienced unusual volatility this year. According to data released by China State Administration of Foreign Exchange on December 16th, cross-border securities investments saw inflows of $188.9 billion in November. However, outflows reached $234.6 billion, resulting in a net outflow of $45.7 billion, the highest single-month record in history, far exceeding October's net outflow of $25.8 billion. Cumulatively, from January to November this year, the total net outflow from cross-border security investments expanded to $47.3 billion. On this matter, Mr. Mo, a fund manager at a large U.S. private bank in Hong Kong, who requested anonymity due to the sensitivity of the subject, told Voice of America that China's stock market has been in a bearish cycle for nearly 3 years, prompting a continuous retreat of foreign securities investors. However, since September, the People's Bank of China and the Ministry of Finance have introduced a series of market rescue measures, including the so-called Three Arrows policy, which triggered a rapid stock market rebound. This attracted a wave of short-term foreign investment. But, as Mo explained, they quickly made 10 to 20% of profits and withdrew their funds just as fast. In other words, the recent bullish run in China's stock market has essentially become a cash machine for foreign investors. Take the A-share market as an example. The Shanghai Composite Index peaked at around 3,700 points in early September 2021, but then steadily declined, reaching a low of approximately 2,700 points by mid-September this year. However, driven by government stimulus measures, the index rebounded sharply over the past 3 months to around 3,300 to 3,400 points, reflecting a gain of over 20%. Mo said that while foreign investors have recently taken profits, they remain generally pessimistic about China's economic outlook. They doubt that the government's monetary easing or increased financial spending will effectively boost the real economy or stimulate domestic consumption to drive internal circulation. A particular concern is the lack of transparency regarding the scale of government liquidity injections. Mr. Mo remarked, "These foreign investors know that the Chinese government sets its growth targets based on data. Now, with all these fiscal policies in place but no clear figures on the actual liquidity injection, investors are still being cautious." Mo also noted that foreign investors are still observing China's economic outlook for the next year, paying close attention to how President-elect Donald Trump's tariff policies might impact China. Another concern is whether the Chinese government will allow the yuan to depreciate significantly to offset the impact of high tariffs. Mo concluded that until these uncertainties are resolved, foreign capital movements will also remain unclear.